All right, I think we can get going here. So this is going to be a non-technical presentation. This is all about IP cycles, specifically around valuation creation in the institutional marketplace. So let's get into it. We're going to be talking about who I am, what I do, a couple of different examples for you around IP adoption, and then Q&A. We can talk later if you want. So I work for an investment bank in Canada that specializes in industrial technology. Another part of my franchise is sustainability, but why I'm here is because I focused on industrial networking and utility networks over the years. And so what I'd like to provide is a little bit of an overview of different IP cycles and the value creation and, quite frankly, destruction of many companies in the past 25 years and what it might mean for the broadcast industry, and we'll get into that at the end. So 3 analogs. Enterprise is a given. Utilities are very interesting, both on latency and service level agreements, which I think is a good analog for broadcast. And this thing we hear about, Internet of Things, and we'll see how those analogs work. So first, on Wall Street, we talk about in terms of networks than applications. And so here on the network side, 1994, the internet takes off. And very quickly, Wall Street follows. For those of you around then, Netscape, who had a monopoly on Java, which created websites for many, many years, it kicked off the boom at $28 a share and $3 billion market cap. Right before they sold, at the peak of the bubble in March of 1999, it was about a $4 billion company, and the bubble took them up to 10. But my point is this. So this is how frothy the market was from a Wall Street perspective. Look at the actual domains that came after that in 25 years. So Wall Street, sometimes we're good at getting trends, sometimes we're not. The big picture trends, the 25-year trends, generally speaking, Wall Street as a collective is pretty good at. And the other thing I want to talk about here is the commonality of the language. People could create their own internet sites, put them up on Java. That was critical. Proliferation, exponential growth. So now here's the good and the bad side of what happened to that. So here's year 2000, top 5 companies by market cap in the United States. I'm sorry for the font. You might not be able to see it. So there's Cisco, and I apologize for anybody who works there or lost value there, but they're still a major hardware provider. However, they were the second largest company in the United States by market cap in that period. In 2007, we've already pivoted away from the network build-out, okay? And now here, look at this. 3 out of the top 5 companies right now in the US by market cap are all software IP-based companies. Now, granted, Apple does a little different thing, and Amazon's disrupting all sorts of things. But for the most part, without a common language, these companies wouldn't exist, and they've been tremendously disruptive. One chart here I want to talk about. A lot of times in jargon, we use the term FANG, if any of you trade your portfolios. So this is Facebook, Amazon, Apple, Netflix, and Google. And they're in the light blue, cumulative market cap. And then Wintel is Intel and Microsoft. And so look at the value creation right around here, 05, 06. So it's not that, monopolies are okay, technology's okay, but if you're in a stagnant end market, look what happens. You don't really go anywhere. Look at the growth of Netflix. We'll get into that later and over the top. But my point is this. When you're looking at deploying solutions, CapEx, OpEx budgets, we'll talk about in a minute, depreciation cycles matter. Our bosses look for this, and our shareholders look for this. That's end market growth. That's not technology. That's not durability of a competitive advantage. Here's another analog in utilities. 40% of the US has smart meters right now. In the last year, 100% of those awarded have been IPv6. Now, granted, there's a lot of use cases on why we need or don't need cellular. This is 900 megahertz based communication, right? So latency's okay. We don't need this data in real time. But my point is, the utility market is taking an opportunity. Back here, this meter costs about $40, okay? Right now, that meter all in to your home is $250. About $120 is hardware. So again, back to adding value with IP. From a meter manufacturer, from a utility, we all pay, if you're on the grid, you pay your electric bill. we're depreciating $3 per meter per month. That's $100 times 170 million meters in North America, right? That's almost $2 billion of growth based on IP. We'll see more about this later. It's interesting, too, you folks know as well as I, depreciation matters, business cases matter. I drew this line on the 35th, 36th latitude of the United States. Why did they do smart meters first? Why did they go to IP first? Because this is where all the air conditioning load is. Lights don't matter. HVAC does. You folks know this with cooling and servers and racks. IP also enables growth. So remember we talked about shareholders and all of us looking for really hockey sticks, we call it. Look at the electric load. This is electric kilowatts sold in the United States since 2012, also known as a dead market. Good for dividend income, not great. Connected cars will change that. So if you're an electric utility, you want to sell more electrons, that's great if we move from oil to electricity. Spending will come up commiserately. IoT, so the third analog that I want to talk about with IP. So this, I'm a bit more skeptical on IoT. It's a bit of business case hype at the current moment. I will want to talk about things, smart retail right now. In Target, North America, 500 stores have visual light sensors and Bluetooth sensors in the fixture. So you walk in throughout the floor, point your cell phone up, and it will tell the company or you where you are in relation to product. The companies that sell, so there's large lighting companies like Quealy Lighting and Cooper and Hubble and some other folks, Philips Lighting you may have heard of. You go from an energy efficiency sale, which is about a 15-month payback. It's about, to a productivity payback, it's 15%. So we're looking at 7% ROIs, return on investments, to 15 or 20. That changes things tremendously. And you see all the different types of end markets that IoT is taking over. So this is basically putting digital solid-state electronics and memory at the edge, replacing an analog or, in some cases, electromechanical device. They also change radically how monopolists price. And so, hold on, I'm going to skip ahead. I want to go back to this point. So these are telemetrics-based insurance policies in the United States. So you either have hardware on your car or use your smartphone, and it's behavior-based premiums. So these are test cases. Insurance is a regulated industry in this country. But look at what the insurance companies are doing right now. Forget about how they insure Uber and Lyft. That's a whole other issue. How they're pivoting at the last mile. These are all, for the most part, IP-based technologies. The big pushback on IP, and we'll get to this, broadcast vis-a-vis content creation, is protocol. In the industrial world, this is just a sampling of the legacy protocols that are out there. We all live in a world where depreciation happens. We bought a piece of equipment for 5 to 8 years. We have to use that equipment. We can't write it off unless there's a tremendous payback. Generally speaking, routers, switches, we need those things to be fully exercised, fully depreciated to migrate. But when you do it, you want it forward and backward compatible. More and more IP data streams. In the case of sports broadcasting, for example, getting an IP router, getting that super dense, that's critical. And then, of course, McKinsey has some data around what they think interoperability is needed. 40% of the whole TAM needs to be interoperable. We talked about insurance disruption. And then broadcast, you all know this better than I do. Nonlinear versus linear progression, really breaking apart what was a traditional, very staid industry from a technology hardware perspective, changing very dynamically lately. So, you know, Amazon, $50 million deal this month on Thursday Night Football. Again, as you all know, live streaming still pales in comparison with broadcast, right? We're maybe 10 or 20%, maybe at best. That's going to change tremendously in the next 2 to 3 years. And I had to put in Over the Top. I mean, you couldn't avoid it. One of the best movies. Anyway, in the disruptor, again, Netflix. Another point I want to make here, as we conclude, I know I'm ripping through some of this, but the different factors at work and the different conditions that are happening. So from Wall Street's perspective, proprietary networks are zeros. They might be able to live in a niche fashion. So nuclear power plants in this country, mostly all analog for the most part. They have dials. There's companies that make those dials. They'll make them until that fleet's retired. That's generally not a huge market. That's probably a $10 million market a year. IP, especially with CIOs and CTOs, as we have convergence, back office, front office, traffic and revenue, non-traffic and revenue, need to have common capabilities. Caps on valuation. You saw the destruction of Cisco. Again, still a fine company, cash flows tremendously well, but not keeping up with the last 15 years. The hard part for OEMs is going to be this question here. How you're used to selling a box, as you see all of these right here, how does the model change from selling software on that box, virtualization? The previous speaker was talking about hosted versus non-hosted, public versus private networks. Some of these OEMs need to figure out ways to monetize the content and expertise they have for software-based networking, how to price that. It's standard, simple. That's critical. Also, from a broadcaster perspective, how your money's flowing. So what I mean here is, this is a cyclical business. So advertising dollars are good, the presidential election is good, the Olympic cycle's good, we have money versus advertising dollars, we spend it on equipment. That's going to moderate over time to that electric seasonality curve. It's going to be flat. How do I price immediately? That's a critical. And then the other thing that's very interesting, you see this on connected cars, if any of you are into autonomous driving, this constant focus between ASIC-based technologies and field programmable. What I mean by that is ASIC, application-specific circuit board, doesn't do anything except that specific application. Very cheap, very redundant. You can extrapolate that technology everywhere. Field programmable, you're giving some intelligence to that piece of machinery. How does that trend happen here in broadcast? OEMs and consumers alike are going to think about that. And then when we're connected with IP, we're hackable, we're disruptible, and we're portable. So business model sustainability, I would suggest, takes on critical importance when you move to IP. So sorry, this is a common thing I do at the end of presentations. I might think I know where I'm going, but the tiger in the market is really going. So this is a personal Wall Street thing, and I think something we should keep in mind for the broadcast market. So with that, thanks very much for that. And if anyone wants to chat, I'm around. Thank you, folks.